So our first presenter is Shane Caldwell. Shane is the CEO of Ballator Insurance Group, the parent organization for the company I work for, Nonprofit Insurance Services. And on a personal note, he's our boss, but we love him anyway. Prior to creating Ballator and Nonprofit Insurance Services back in March of 2007, he served in various senior management positions with a nationally publicly traded broker. We always find this session to be of great importance and a wealth of information, and looking forward to what he's got to offer this year. So thank you all. Take it away, Shane.
Hi. Thanks, everybody, for attending. I'll echo everybody else's sentiment that we really wish we could be in person. We really enjoy the camaraderie, but we're going to do our best. And my job is to bring everybody up to speed on the state of the insurance market, as well as an update on what's happening with FIT. We are very excited that this is the 14th year. My issue is I try and come up with a new theme each year so that we don't do the same thing every single year. And I was really having a hard time because after 14, we've covered a lot of stuff. But ultimately, what I came up with was I was thinking, well, what's actually happening pertinent in the world? So obviously, you're going to hear a lot about the coronavirus and coverages and all of those types of things. But really, if you exclude Corona, which obviously we have never had that issue before, but if you look at all the stuff that has come from it, I was thinking back, this takes me back to our very first conference and as to why we actually started FIT. So the theme we came up with was have overcome and will overcome. And what that means is if you look at this year all by itself, obviously the coronavirus is terrible. We've never had that happen before. But I think everybody's heard that this is the third most active hurricane year in modern times. Well, the other two most active years, the number one and number two, were 2005 and 2006. And it's actually a result of why we started FIT in the first place. It was a hard insurance market. People couldn't buy insurance. And we came up with a way to provide insurance in a cost-effective manner, and most importantly, be consistent with it. If you also think back to 05, 06, the financial markets are in the tank, just like they are now. There was a whole lot of home foreclosures, which there are now. So if you really think about it, 2020 is not that unlike 2007. So with that, I'm going to try and get into about 15 minutes of the state of the market. It's a little bit dry because there's no way to make it exciting, but I'll try my best to at least explain it. I'm looking forward to getting to the second part, which I'll tell you about the status of FIT. Michelle, who put this together for me, did a great job of all throughout. There's some little fun facts, but this one, we were thinking back to what was happening in 2007, and Michelle did the research, and actually the first iPhone was released on June 29th, 2007, which it just so happens that it was actually on June 1st, 2007, when FIT wrote its first policy. So we thought we were doing something big, and then Steve Jobs comes back and one-ups us literally within 1 month. So getting on to the state of the insurance market, we really have to talk about this year in three kind of time frames, because there's the early market, which is January, February, and early March. Now, at that point, going into the year, when we meet with markets, everybody was indicating we were looking at 10, maybe 20% increases, which is hard to swallow. But there was capacity, although people were picky. And the reinsurance market, that's the insurance that insurance companies buy, was fairly stable. So it was, even though the pricing was going to be a little challenging, it was not that tough of a time. And then, of course, when you get to the next one, we're looking at from mid-March till April. This is when in the insurance world, everything just kind of blew up. We had the corona pandemic came out. And of course, now in retrospect, we kind of know what that means. But at first, from the financial world and the insurance world, it sounded like the whole world was coming to an end. Big time political pressure on property carriers to pay business income claims. And we'll talk about that a little later. The Florida Office of Insurance Regulation came out, as did many Office of Insurance Regulations, and gave us some guidance. And the guidance was that first responders and healthcare workers were going to be covered under work comp for COVID. Other states have gone much further. Take California, for example. They went as far as the state came out and said COVID is going to be covered. So there's still pressure up in Tallahassee. Florida is a very business-friendly state, so we think it's going to stay the way it is, but nobody knows. But because of COVID, the reinsurance underwriting became a lot more restrictive on coverage, limits, and capacity. And almost everything in the insurance business, it kind of starts at the top and works its way down. And kind of at the higher level are the financial services and the reinsurance. So obviously, as the reinsurance went up and became unavailable, the pricing for insurance went up and got more unavailable. And then you kind of get to the most recent period leading up to now. Things still are unknown of what's going to happen with COVID, but the Lloyd's chairperson came out and said coronavirus could be the most expensive event in history, which would mean that it was a $50+ billion event. And he really said that because a lot of stuff ends up going back to London, and they're going to get hit with a lot of claims from all sorts of different coverages, where the domestic carriers tend to provide more limited type coverage. And yes, they got exposure, but probably won't get hit as wide. The rate increases, which just 3 months earlier, 20% hurt. Well, those quickly became 30%, which really, really hurt. All of a sudden, carriers started reducing limits that you could buy. And I'm sure, we all saw that at our renewal. Because there's this question of coverage, some policies already had communicable disease exclusions. Well, now almost universal, every carrier has actually came up with their own specific coronavirus exclusions on virtually every policy. Now on property, if you think of this circle, if you think of that as a stool with 5 legs, what all of us talk about the most and we feel is the top one is the pricing. So that's going up. But just as important for property coverage is the capacity, the coverages, the reinsurance cost, and the industry loss ratio. So all of those things come together. As a stool, if you start getting one of those legs out of kilter, obviously the stool gets a lot less unstable. If you pull 2 of them out, the stool's not going to stand up and it's going to fall down. And what we're trying to do and what our goal is to keep all 5 of those things firmly underneath our circle. And that's how we can control pricing and availability. Like one note on coverage, and I'm sure I covered this a little bit later on, but we fought really, really hard to keep our coverage form. We talk about this every year, but it's a proprietary coverage form that covers a lot of exposures that nobody else covers. So for instance, there are people that I know that are on this call that when the hurricanes came through, they lost locations that they didn't know they had. It wasn't on their schedule. Well, it just so happens we have coverage for miscellaneous unnamed locations. So they even got reimbursed for the locations that they didn't even know they had. And I could give you 3 or 4 other differences of coverage that are very important. A lot of our coverage comes out of London. We have to make several trips a year to go over there. And I could tell you, we spent an inordinate amount of time making sure we didn't give up the coverage and try and keep the pricing in line. And the easiest thing in the world to do would be to take more standard coverage and let the pricing moderate even some more. This line graph, it's pretty easy to read. If you look at it, I mean, it runs from September of 17th to December of 19th. And this is just month by month what's happened with the aggregate property pricing. The trend is pretty obvious. Now, the information isn't out yet, but what would be super helpful is if we had 2020, because if you just imagine that line that ends on December 19th, you're going to start seeing that thing go up at about a 45-degree angle from the start of the year all the way through 2020. So it's not a very good trend as far as being buyer friendly for any kind of insurance customers. The next one, historically, Property has not had development. So you have a loss, the adjuster works with you to peg the loss, and then you rebuild your building, as opposed to work comp that we know when a work comp claim happens, it's going to continue to increase over 4 or 5 years. But now all of a sudden, you'll notice these are the hurricanes from 3, 4, 5 years ago. And these are the developments. And this is essentially over a 2-year period. And if you'll notice, Irma actually went up 34% from, in aggregate, what all the adjusters thought the losses were going to be. And it's really something that's new over the past, say, 10 years, which is a demand surge. We now know that when you have a hurricane or any other kind of catastrophe, that our cost, or the insurance carrier's cost, are going to go up. It's even much, much worse when a whole region gets hit. So you can imagine what's happening in Louisiana, Mississippi, and even the panhandle of Florida, because the people that didn't have roofs, they're not going to get roofs for a very long time, because there are not enough contractors, and I can assure you there's not enough roofing tile. So then you're sitting there with the poor folks that have the blue tarps on them for literally a year. So this is something unusual in property. The carriers have started to factor that in, which is why you're seeing the pricing go up, because their exposures are actually going up. And now we have multi-years of experience to show them exactly how much. Okay, so some key takeaways from property. The real impact of COVID-19 looks like it's going to be on the business interruption. It's been tried in several jurisdiction courts at this point. There have been a few that sided with the insured, but the vast majority have sided with the insurance carrier, saying that you have to have physical damage for there to be business income. And a virus is not physical damage, and that's coming from the courts themselves. The hurricane activity over the last 3 years and claims development on Irma claims, I made that comment on the last one, which our insurance carriers now have a number to put to their initial assessment, and those numbers are going up, and therefore they're looking for their premiums to go up. The overall industry capacity is actually not bad. However, carriers are scaling back on deployed capacity. So even though the coverage is there, they're pricing it at a point that nobody's going to buy it. Coverage restrictions are obviously impacting certain areas of BI. Certain of our classes have big BI exposures. Certain of them do not. The ones that have big BI exposures, we need to be able to provide that business interruption coverage. But because it hasn't completely played itself through the court system yet, nobody knows what that's worth. So a lot of the insurance carriers are just excluding or not providing business interruption until the courts clear out some. We're still seeing rate increases for cat property of 15 to 30%. Now, when I get to the update of FIT, everybody will see these indications of pricing that I'm giving you. This is not the amount that FIT members paid. We've got a mechanism that we think is better. These are the increases the commercial insurance carriers are putting out to people. And also submission volume is very high. But again, there's getting to be very little flexibility or exceptions, where just a couple years ago, if we needed an exception, it was fairly easy to get. Now to talk about the general liability and the professional liability. Now, this market, starting several years ago, had been very stable. But a big thing came along called social inflation, and that remains the key driver for deployment. There's not a day that I don't read a new article by somebody in the industry talking about social inflation. And for those of you who haven't heard the term, social inflation is simply a preponderance of, and I don't want to use the word millennials because it's not just millennials, but younger people seem to feel a little more entitled and are more likely to bring lawsuits. And then the court system is being more liberal with the judgments. I actually read one this morning that over the last 10 years, the average size of a judgment has grown by over 50%, which is very, very substantial. Sexual abuse coverage continues to be a concern for the insurers, always has been. But again, one of those last points where it's hard to get concessions, they never really wanted to provide them. We needed it. We would ultimately negotiate it, but it's really getting harder to get that line of coverage. Once again, like the property, the recent renewals from standard insurance companies have been in the neighborhood of 30%. Now, I'm sure everybody experienced this year. The excess liability and or umbrella, once you get above 1 or 2 million, the price increases is 50 to 100%. And in a lot of cases, they just won't provide it. And that all goes back to that social inflation. If they limit their coverage to 1 or 2 million, they kind of take that off the table because they can account for what claims are going to go from 1 to 2 million. If you have, we've had members in the past that bought 50 million, you really can't adequately price for 50 million of coverage when you could have a $50 million jury verdict. And then, of course, the COVID-19, there are legislative initiatives, I can tell you, in virtually every state, if not every state. Again, Florida so far has been very business friendly, and we haven't had, there's both sides of the aisle are working this very, very hard. Industry groups are trying to get the governor to pass a statute that would give immunities to businesses that kept their people employed. And next, I want to talk about the casualty rate. This is the liability. Once again, I used a very similar bar graph. You can kind of see the way it's heading. And again, this was over the 3-year period, not including the one we're in. So you can see at the very end that November, December already had a pretty steep slope. Now imagine going to March with the background of all the stuff that we've talked about so far, and those pricings are getting a little on the ridiculous side. Let's talk about the state of the auto market. I think everybody that's on the podcast has seen rate increases over the past 3 years of about 10%. So the rate increases on auto sort of were baked in where they weren't for the property and the liability. Recent renewals have gone down on the increase, not down on price, but now we're looking at rates from 5 to 10%. The key driver is still the same thing. We talked about this. As a matter of fact, either last year or the year before that, we had a session on it, which is distracted driving and increased cost of vehicle repairs. Those are sort of self-explanatory at this point. An interesting thing is, despite the reduction in frequency of auto claims, there still seems to remain a severity concern. So, I mean, essentially what that means are people are driving less right now. Not everybody's returned to work. I know we're still working remotely, but people tend to be driving in a more careless fashion and faster. So although there are fewer claims, we're seeing more severity or larger claims. And then, of course, that last point is there are fewer vehicles on the road, and that has, again, helped the frequency, which is why ourselves, along with most of the personal lines carriers, actually gave back some auto premium because we were seeing fewer auto claims. Now, and I point that out because everybody's seen the residential insurers or the personal insurers giving back money. If you'll notice, you never saw any commercial insurers doing that. We thought it was only fair. Essentially, what we saved from claims, we gave back to members, and I don't know of another commercial insurance organization in the country that did that. So, we appreciate everybody that's on as clients, and we'll continue to try and help you control your costs as best we can. And finally, the state of the market for work comp. As of January 1, 2020, OIR approved a decrease that was proposed by NCCI. One of the knocks is with the COVID, most carriers consider social service and nonprofit agencies as healthcare. And where that becomes a problem is, again, from a work comp state coverage, those workers are going to be covered under work comp. So it's detrimental to a lot of our members who, some of them have some health care. Most of our agencies that we insure are not healthcare agencies, but the insurance company look at it. The work comp for the frontline workers in healthcare are the ones that are the most challenging to renew. That kind of goes without saying. On a good note, the work comp has enjoyed a soft market for several years. So where all these other lines, I'm giving you sort of a doom gloom presentation, the work comp is actually improving some. One thing that happened, NCCI came out, and NCCI is National Commission on Compensation Insurance, and they are the rate making agency. They're not a state run agency, but they provide proposed rates, and the various states adopt them. They gave guidance, and all the carriers in Florida have followed it, which is one of the reasons we tell you turn in every COVID claim that you have, is because they need to be adjudicated to find out if there is coverage. And NCCI says, while we have to cover the claims, we can't count the number of losses against you in your experience mod. So therefore, just make sure you turn in those COVID claims. We're going to adjudicate them exactly as the state law requires. And the impact of COVID may be significant for essential business workers groups. So that's where we're going to make a lot of our time and our marketing efforts explaining to our excess carriers why most of our pool is truly not healthcare. We don't want to get lumped in to those classes of business where the carriers think they're going to have to be responsible for paying for everything. Okay, now that we've talked about the boring stuff, which is just where the markets are, let's talk a little bit about fit and how we're doing. And again, I want to remind everybody as I go into this session, because it's a little bit more exciting. On the right-hand side of your screen is the little toolbar. If you have any questions, normally we just kind of have a question and answer session right here live. But if you have any questions, please type them in. We've got Justin standing by, and when we're done, I'll do the best to answer any questions that anybody has. A fun fact that Michelle put together was 14 years ago. Again, that's when Fit started. Yahoo.com was the most popular website. Today, it's the 47th. I didn't go as far as asking her what the number 1 or 2 is, but I think we could all guess at this point. So a lot has changed in 14 years. Now, normally, this is where for several years, and I finally decided to take it off. Normally, before this, I go through a timeline because there's a lot of new members that are online. And so some of this stuff, I apologize. For those of you who have been to 14 of these things, some of them are going to be a little bit redundant because it's really important that our new members understand pooling and how it works. Then I usually have a line graph that shows the history of insurance pooling. And the point is, insurance pooling was the first type of insurance thousands of years before the first insurance company ever wrote its first policy. The ancient Samoans actually were pooling their resources so that if something happened, no one would be completely put out of business. So then you jump to, okay, who in Florida can pool? Because every state has a different pooling law. As far as I know, every state allows pooling. It's just differentiated by whom it is that can pool. So in Florida, there's a separate statute for each of these. The first one was local government. The next one was public utilities. The next one was housing authorities, then independent educational institutions, then electrical cooperatives. And finally, the statute that we helped usher through was the nonprofit organizations. The local government, the first one, that dates back to the late 1960s. And obviously, the nonprofit was in the legislative session of 2007. And if you look at these types of entities, it's obvious what the state is trying to do. These are all entities that provide services to the citizens of the state. They're essential services, and most of them are supported with tax dollars. So what this actually shows is the state government has identified that pooling is a more efficient way to provide insurance, or else why would you take these classes of entities and pass laws specific to where they can pool, but they won't let say contractors or apartment buildings. So those are the 6 classes that can pool in the state of Florida. And here's a few things. Again, this is a little redundant for those of you that have seen it, but we were formed under 624-4625. That's the statute of those classes. That's the one our particular statute is. The pool is governed by a board of directors, and under that statute, the board of directors have to be fit members. We do submit financials and actuarials to the Office of Insurance Regulation every year. As a matter of fact, our filing time is the same date every year. It's on or before December 1st. So our audit is pretty much done at this point. I'm going to go through some numbers, but they're going to look the same as the audit, although we're probably still a week and a half from turning that in. We must purchase excess insurance from authorized carrier. So another thing that the state baked into the statute to make sure that these entities that participate in pooling are financially secure is I'm going to get into how much reinsurance the pool buys. Well, not only does the state regulate the pool, the state regulates all of the carriers that we buy insurance from. And a majority of our risks, specifically the catastrophic risk, are transferred to A-rated carriers. And, so that's how we've paid out so much in claims in comparison to the financial position of just the fund on its own. Now, Michelle has, and I'm going to let it run for a minute or two here, but I wanted to show everybody because we really do have a good time, and the people that have came tend to come back. We do have a lot of new people signed up this year. So we're going to run a very short video to just show you scenes from, it was actually last year's annual conference. So I'll kick back on here in a couple minutes, but everybody take a quick look and remember how much fun we had last year and how much fun we're going to have next year.
Insurance Trust Educational Retreat. And we've grown from just a few members. And I wanted to recognize the 3 originally founding members who are members of our board. And that would be Joe Andello and Jim Weeks and John Cherry. These 3 folks had the foresight when Shane came calling that first day way back in 2007 to take a chance on Florida Insurance Trust, and saw that it was a great idea, something brand new to the nonprofit social service market.
A few things that you should know about FIT. I think most everybody in the room knows this. We were formed under a Florida statute that was passed in 2007. We're governed by a board of directors who thankfully has been very stable and consistent. They're also very personable. So if you don't know them, take a chance to meet them over the next day or two.
Well, at conference, you get to meet your colleagues. Also, the presentations or, renew relationships. But also the presentations help us with our work, whether it be about sexual harassment, whether it be about, computer fraud, etc. They're timely and they're beneficial.
Sexual harassment is not about sex. It's about power. You have to immediately investigate. You have to have a culture of safety. You need to make sure that you've crossed all your T's and dotted your I's. And that's how you protect yourself, your company, and your employees.
There's not a single industry that is untouched. Because if you are connected to the internet, it doesn't matter which industry you belong to. You will have employees, you will have customers, you will have sensitive data. And that's what, as a hacker, I'll be interested in. In today's age of Facebook, Instagram, and all the other social networks that are out there, LinkedIn, I can check out which high school you went to, which year you graduated, what your mother's last name was, what the name of your pet is in not more than 10 minutes.
One of the other things that makes FIT special is it's a true membership-driven program, to where the membership itself, they actually own the insurance trust. There's no stockholders in the insurance trust to pay, so that really...
Hi, everybody. That's just to remind everybody what we would be doing. Could we meet in person and hopefully by next year, we'll be able to. That whole video is about 7.5 minutes long. It shows a lot of the highlights from last year. So anybody that would like to watch the whole video, it's on our YouTube page. You can tell how technologically advanced I am. But it's on our YouTube page. So please, if you have time, go take a look at it. It shows some very fun times. Now, as far as the fit service partners, when we run these things and we're kind of the face of the organization, we have an important role to play, but there's a lot that goes on behind the scenes. Under state statutes, we have to have a third-party accountant, and we have what we think is the best, Shores Tagman. They provide the accounting services for over 100 pools around the country, so they are the premier pooling accountant. Ed Costner at Casualty Actuary Consultants, they're up out of Nashville. And once again, these aren't names of like the big three accounting firms, but they are the accounting firms that are the absolute best at what they do. The agent partners, I mean, we put a lot of responsibility on the agent partners. We do limit them because we do need partners, and I'll explain why in a little bit. But there's only 8 in the state. And they do a tremendous job of understanding our product, understanding the needs of their clients, and making sure the two match up. Administration, that's actually of all these different services, administration is all that we actually as NPIS do. There are several things that make up administration, but certainly not any of these other services. The legal, we use Jack Brennan, the Brennan Law Office in Tallahassee. Jack's came to some of our events, and he certainly talked to some of y'all in person, but he's out of Tallahassee, and his whole practice is dedicated to insurance-related issues. So that's all he does. And then, of course, our claims and loss control is with Sedgwick, which happens to be the largest claims administrator in the world. Our claims are handled out of a Boca Raton office that's been there ever since we started Fit. In fact, we have most of the same adjusters there. The cohesiveness of having those claims accounts for a lot of the financial success of Fit. We always get questions how year over years on any particular one given year, an insurance company can come in, lowball your insurance, but how can somebody do it consistently for 14 years? And it's a real simple answer. It comes from two sides of the slide. One is we have intentionally lower fixed cost of operating. So admin, what we do as the administrator, we do for about 10% of every dollar of premium. An insurance company, it varies a little, but on average, that's about 16%. One of those issues that I brought up about the partnership agents, typically an agent from an insurance carrier will get paid 10% for workers' comp, and we ask them to do it for 6% because it's better for the client. And because we're dealing with volume on each, they still make a decent living. But again, that's an additional 4% savings. And the same thing on the property casualty. A standard insurance company pays 15%, and we only pay 10. So, I mean, essentially, and then lastly, on the fixed expense side, the taxes, the state tax for pools is across the board 1.6%. Those are premium taxes. For standard insurance companies, those vary between 3 and 5% based on the line. They're different rates based on which line of coverage. So if you add all that stuff up, we've got a 15% advantage before we do anything else. And then when you have industry specialized claims handling, we close claims. And I think at this point, almost everybody on the call has had claims with us. And you'll know, I mean, we want to handle them judiciously, but we like to close those things down. From our experience in this class of business, the longer you let something sit open, the bigger it's going to get. So we actually track the statistics, and we close claims about 30% faster than standard insurance companies. And we have very few legacy claims. When we do our actuarial every year, of course, they develop it. And if you just go back 4 years, I'm not going to say there's none, but there are essentially no claims left open, which 4 years sounds like a long time, but in the terms of insurance world, it's like overnight. Now we're going to talk about the financials, and I'm sure we'll get some good questions on this at the end. Fun fact, and this is sad because this is me, but for the last 14 to 15 years, 1, 2, 3, 4, 5, 6 has been the most common password. I think I had that until they kicked me out and made me do something different, and then I did 6, 5, 4, 3, 2, 1. So, but no, that is kind of a pain. Now everybody's having to, for additional security, change your password every month or two, and it can be a pain. So I'm sure everybody experiences that. From a financial summary, again, full financials are filed with the state. Anybody that would like a copy of it, it's kind of boring reading. I'm hitting the highlights, but they're available. Just contact us. But the important numbers we actually pulled out to the side. So member contributions, if we were an insurance company, that would be called premiums. We're up to north of 50 million. In fact, if you take us year to date, we're up to about 54 million, up from 44 million last year. So we had good growth. We had good growth because we didn't have to go up nearly as much as those commercial insurance companies that I was talking about in the last part of the presentation. Carrier expenses. Now, this is an important number. I'm going to refer back to it. This is the insurance that Fit buys. Now, remember, this is from the last policy period, not the policy period we're in. So the total carrier expenses last year, we paid $13,671 and some change. The loss-related expenses, these are just essentially claims. We paid essentially $23 million in claims in the policy period we're talking about. The underwriting expenses, that's essentially, you can read everything else, but that's the commissions to agents, the third-party administrator, the taxes, the pool expenses. That's all. It's line itemed out there for you, but I pulled it out as a pull out, so you can see that that's 13. Net investment income earned. My goodness, I would give anything if I could get back to this, but we earned $439,000 in investment income in the period that we're talking about. That's essentially gone back to zero with all the interest rates, because we are very highly regulated on what we can invest in. And I mean, it's essentially U.S.-backed securities or state-backed securities. So the net income from this year is $923,026. You'll see compared to last year, which is the right-hand column, we had put $822,000 into surplus. So when we go to the balance sheet, we'll review the total surplus. So going on to the balance sheet, you look at our assets. I mean, there's, like I said, we're highly regulated. There's not much fancy stuff we can do. The cash and cash equivalents are most of it at $27 million. The total assets, so the only difference between the cash and the total assets are receivables of various types that you can see what they are. But essentially, at any given time, the agents will owe us some money. There's always the insurance company owing us money back for claims that we've already paid. The expenses are $39,634,000. And so, and again, you can review all the different classes of the liabilities, but essentially it's taxes, premiums payable. So the fund balance, which that's the surplus, is $2.962 million. So roughly $3 million on $50 million of premium. One thing I always like to point out is, and this is a differentiator between buying from a pool and buying from a commercial insurance company. A lot of our competitors will make you think that we're paying the claims out of that $2.9 million. That's just not the case. That unpaid losses and loss adjustment expenses, that $39 million, it's on the balance sheet, of which $22 million or $27 million are actually sitting there in cash. That's where the claims are paid. The additional money is surplus money that we have over and above what we need to pay claims. It is good to have a cushion, but in 14 years, we've never had a negative year. We've never dipped into surplus. And at a certain point, we actually have to look if maybe we want to do something different. So this year, even though surplus went up, we used some of that to decrease the premiums to members, because I've got an exhibit coming up here that shows how much Fit paid for insurance versus how much was charged. And that's a prime example of it's nice to have a little, dry powder. Another little graphic representation of where we're at in members and written premiums. As you can see, they're pretty much in line. We have for all 14 years, we've grown in membership every year. We've grown in premiums every year, and we've grown in surplus every year. And they all seem to be fairly proportionate. Now, all these big claims that we're going to talk about, where does the money come from? Well, obviously, Fit keeps a primary working layer, so Fit does pay some. In fact, we saw the number, and it was $23 million this past year. That's not what was paid in total. That's just Fit. Our excess and reinsurance partners these are the four major ones. There are some additional ones, but the importance of it is, if you look at that Best rating, Best is a rating agency that actually has a numerical and a alphanumerical number that represents. So the letter represents how well Best thinks the company is run, and that's from an A to a D. And then the financial number is based on the financial size, based on their surplus. And from a letter, A is as big as you get, and from a number, financial class 15 is as big as you get. So all of our reinsurers are the most financially sound reinsurers that Best reports on. And they're the ones, when we get hit with the hurricanes, they're the ones that pay the big claims. So it's still, and I think everybody recognizes Lloyd's. You may or may not recognize Brit or Markel, but again, they're A plus 15. So that kind of represents itself. This is the exhibit that I was talking about. This is what I think everybody will be interested in. So our reinsurance, we go through the same process that everybody goes through. I mean, we have to go out to market. We have to travel all over the world because the markets are worldwide. And our reinsurance, the reason I pointed out the importance of that $13 million off of the profit and loss, that's what we actually paid for reinsurance last year. This year, Fitz Reinsurance went from 13 that I pointed to 20. So our reinsurance went up by 50%, which gives us a lot of heartburn. So, our commitment to you membership is, one, you will never get surprised, and, you're going to know what's happening. We certainly didn't want to come out to you and tell you, oh, it's looking like 50%. So we quick and went to work, and the Fit members rates increased by plus or minus 15%. And all of that is because Fit absorbed the difference in cost between what Fit got charged and what we charged members. And most importantly, like I said, is the stability. We've never had a year where the increases, I think this was probably our biggest increase year I know it is, that we've ever had, but we delivered very few double-digit increases. And like I said, our biggest promise is you're never going to get surprised. When we first created Fit and got in the business, it was very common for carriers to wait till 3 or 4 days before renewal and show up with the 50% increase. And I know we can't run our business that way. We would never ask you to run your business that way. Therefore, we have mandatory quarterly meetings with the agents. At those, we set expectations of what we think, and the agents come and pass it along to you. And we'll continue doing that process. And we also commit, we're not going to give you a renewal that is less than 30 days ahead of time, so that if you need to make some arrangements, you have time to do it. This next one, it's kind of hard to see. That's why I did the call outs, but it's the property modeling. And we get asked on a somewhat regular basis, well, how much property insurance did you buy? Because everybody is worried about hurricanes and other catastrophes. Well, all this is a little excerpt from, this is the generally accepted property modeling that the whole insurance industry uses. Insurance companies use it, insurance pools use it, and the whole report is about an inch thick, and it lists thousands and thousands of locations and all their constructions, and they run it through a very fancy model, And they come out with this, and this is kind of the cover page. And what it does is it provides the probability starting out at a 20% probability, which would be having a big storm every 5 years. And it goes all the way up to, 1 in 1,000 year storm. The point of reference for this is the takeout insurance companies, which are all of those homeowners companies. And I think there's 40 of them in the state that the state oversees. They require them to buy to the 100-year event. So at the 100-year event, the number for FIT would be $33 million. You can see the 250-year event. That's the gold standard that the state requires of A-rated admitted insurance company. And so therefore, if we were holding ourselves to their standard, we would need $51 million. If you go up to the 1,000-year event, then we get up to $89 million. FIT buys $100 million worth of property coverage. Now, on a year like this, when the property is going up so much, it's easy to ask, and believe me, we had a lot of hard conversations. If 250 is enough for an insurance company, don't we just go down to the 51 instead of 100 and save the money? And yes, that would have to be considered. The board of directors would have to approve it. We would certainly come out to everybody and explain it. But it was important to us that we kept both the property coverage and the limits. And therefore, that slide about how FIT kept the property pricing and overall pricing down, that holds true. And just to give you an idea of some of the losses, this is, I think, just over the last 2 years. I mean, you can see we've had $4 million losses, a whole bunch of ones, 1.7, 1.2 on all different kinds of classes. Oh, I just got a note slipped to me. Peter just informed me this past year we actually bought $150 million of loss limits. So thank you, Peter, for correcting me. I can tell you personally, I haven't seen the modeling be incorrect. But I would certainly rather be more on the conservative side. And I mean, I think everybody gets the idea of how conservative we are. So kind of our takeaways from this, we always, every year we try and look at what we did good and what we did bad. And, what we feel like we made advancements on this year on behalf of our membership is we did issue 15% auto premium credits for April and May, as a result of decreased claims from nobody driving on the streets. We expedited all the work comp premiums where people were expecting a return premium, again, trying to get some of your insurance dollars back in your pockets. We've given back $400,000 to the benefit of the membership and some partnering associations. We obviously, everybody knows we get invited, and it's an important element of our job to actually participate with you and all your fundraising activities. We understand it's important to you. We try and provide as much as we can. And eventually, we're not going to be able to say this, but in 14 years, we have never given a non-renewal due to claims history. It just infuriates us, even us that are in the insurance business, how an insurance company will take your money for 20 years, never pay a claim, and then when you have a claim, they cancel you. I mean, I can tell you that infuriates all of us, including me, more than you'll ever know. And that's what we commit that we'll never do. We're going to be an insurance partner. And when you have a claim, we're going to come and cover it for you. I think that's it. Time for some questions and answers.
Good afternoon. Justin Wiley here, and we do have some questions from the audience for you, Shane. The first question is, can you please explain the difference between a general liability and a directors and officers or D&O claim?
We get that question a lot. General liability is typically property damage or bodily injury, so it typically involves touching or harming something. Directors and officers provides coverage for the board and senior membership for wrongful acts. So that typically doesn't involve touching. So if you think about what you would do as a board, hiring practices, firing practices, sexual harassment, that almost always falls under the D&O, or the general liability. It is what it sounds like. It's just general. Your slip and falls, like I said, personal injury. We happen to be in the same building with Morgan and Morgan. So the whole top half of this building could tell you all about that much better than me.
Question number 2, how are COVID claims relating to general liability and workers' compensation going to affect the financial standing of FIT?
As of right now, the claims are trending just fine. We do have a lot of COVID claims. I get reports on COVID claims broken down at least monthly, sometimes weekly. And what we're seeing is we are paying quite a bit of COVID claims, but the other claims, because people aren't working. So we talked about the auto claims were down because people weren't driving. Well, people also aren't working, or they're working from home. And so all other claims are at this point offsetting the COVID claims.
So question number 3 is, do you expect umbrella coverage to continue to increase in price? And how do you determine the proper amount of limit to buy?
Wow. Okay. That one gets a little tougher. Yes, from everything we've heard, excess limits are going to continue to be very costly and hard to get. I mean, I do think they will be available, but it's just going to be a cost factor. I can tell you, I don't know the exact statistics, but a lot of our membership that had traditionally just bought big limits because it was cheap, everybody rolled it back, at least for this upcoming renewal period. I think we're going to see a very close to what we saw this year, which is some organizations, if you have a lot of health care or a lot of children's services where you have abuse, we're probably going to be limited on the number that we can get you. If you're not in one of those classes, we'll probably be able to get it for you. We're just going to have to work our butt off to try and get it at a cost-effective price. Oh, and the second part was, how do you determine how much you buy? I actually went to Florida State for insurance school, and this is one that, even going back to my education days, I don't think anybody could tell you. It sounds like a cop-out answer, but you just got to buy as much as you can. I mean, at a certain point, it's always smart to buy high limits. I do know certain of our members, in fact, a couple of our board members, take a little bit of a different approach, thinking whatever their limit of insurance is what they're going to get sued for. So people take different approaches. I don't know of any standardized answer other than get options every year, and it's smart to buy it if you can. So buy as much as you can, but there does come down to a practicality.
Good answer. Question number 4 is, what is workers' compensation Part B?
Workers' compensation Part B is something that you very rarely ever hear about. But when you actually get your work comp policy, coverage A is your statutory limits, which there's not a dollar associated with it. It's literally, if you have an injured worker, they're going to get their statutory benefits, which is they're going to get their health care paid for, and they're going to get their lost time paid for. So that doesn't have a limit. Coverage B, and I've never seen one of these in my insurance career, and I'm not sure if anybody on our staff has. Coverage B is a true liability limit, because you could have a comp claim that is so egregious that the courts of competent jurisdiction can make workers' compensation, which is supposed to be an exclusive remedy, which means if you provide work comp, your employees can't sue you. Yeah, that's true, but it only goes so far. In certain egregious situations, a court could say that you have a liability issue on your hands, even though it was an employee, and there will not be any coverage under your general liability because there's an exclusion for things at work. So it's actually a liability limit. You never see it used, but it's to cover in the rare case that you're held liable for an egregious claim.
And the final question, Shane, for you is, and I think it's relating to our third-party administrator, is Sedgwick formerly York?
Yes. In our wonderful insurance world, organizations of all sorts are rolling up. Now, the thing that we have going for us that we feel very good is we actually started back in 2007 with a company called F.A. Richard. They were out of Louisiana. I thought that they were the best claims administrator out there. York, several years ago, I want to say maybe 5, bought Farah. We were able to negotiate utilizing the same office that's down in Boca, keeping the same management and the same adjusters on. So we technically moved from F.A. Richard to York, but the claims kept going well. And just this past year, York got bought by Sedgwick, who is the largest claims administrator in the world by a very good bit. And those negotiations are actually going on as we speak, which is we're pretty comfortable with the way they're handling claims. We want to make sure they're absolutely best in the business. So we're looking at that right now. But yes, York is now Sedgwick, but it's still the same Boca office. It's still the same management, and it's still the same adjusters. And of course, from our standpoint, we have Jennifer Lister, who I think everybody knows. She does a great job of staying on top of all of those claims. In fact, she meets most of the people on this call for monthly claims reviews. So as long as we have us running herd over it, I feel very good about our claim situation. And now I'm here, obviously all day today and all day tomorrow. We've got a great lineup for you. I'm looking forward to seeing the other presenters. But even in this format, if people have other questions, please go ahead and enter them, and I'll make sure I either readdress them before we close, or I'll just, give you a call personally and answer any questions. And now I think I go back to the Mad Hatter. I think Doug's got another giveaway.